Hey everyone, it's Zach with Palantir Research. Palantir's earnings are coming up this week, pre-market on November 2nd. Now, thinking about it first, since Alex Karp is in the UK right now, it kind of makes sense why they're doing this at this time early in the morning for the United States folks, because they'll be later in the day there. Whereas if they did it after hours, it'd be close at nighttime. So that's just a random thought, to be honest. But the meat and potatoes of this video is, in addition to my latest video on the expectations of Palantir's earnings, in my opinion, to go well. But this will cover how certain metrics can make earnings go wrong, albeit some of these are more or less likely to occur, in my opinion. So let's go through these in order of least to more realistically to happen. Now, a dagger for Palantir if it were to occur, but I think least likely to happen, is them missing GAAP profitability. Now, the past 3 quarters, they've been inking it out at 1 cent per share, which is a technicality on the first quarter they achieved it, but this also goes to show why it's least likely to happen, since management can usually pull levers to eke out that positive EPS if they are borderline like Palantir has been. We know they've been cutting or maintaining expenses when it comes to SG&A, or maybe not as much now on the sales side because of the AIP boot camps, but also in the R&D department here, nothing significantly going up. But in Fantasyland, if this were to go negative, it would hurt because it delay S&P eligibility that everyone is pretty much expecting is in the bag. Now, the second thing that can go wrong for earnings is their operational cash flow decreasing big or possibly going negative. This hasn't happened in recent memory in forever, but now we've seen Palantir ramp up in recent time with their AIP Con and AIP boot camps. Now, it's not necessarily the most low-cost way to push out sales because these demos are run by Palantir employees with guidance and take place in certain places around the world, which I'm assuming a certain amount of customers can make it in there at a time, so meaning that they still have to run multiple possibly if they want to get more customers. And then there are expenses associated with that, of course. Now, I obviously don't know how much these cost or even if it actually pushes the needle when it comes to burning cash, since we haven't seen it in recent history of this being an issue. So that's why I only put it this second here as something that would be horrible for the stock, but I still don't think it's likely. And I think investors would never want to see this negative cash flow. Now, stock-based compensation or SBC runs higher than expected. That's the third one. Now, we've gotten warnings that later in 2023, we should be expecting this to go up from management, but we don't know the exact magnitude here or what to expect. I know the chart of stock-based compensation as a percentage of revenue has been going around every earnings with the ever-declining ratio, but of course, there are 2 parts to that equation as long as they grow revenue faster than SBC. So we should expect this ratio to continue decreasing if that's the case. Now, the reason I put this third is because we got the heads up from management, and I can see this possibly occurring if they are ramping up AIP boot camps and needing hires on the ground as their technical sales force needs to grow to meet the high demand that they are saying. So this will be interesting to see if this has been a constant story up here, because the media will always play on this if it ends up ticking upward. Now, the most likely to occur, in my opinion, doesn't mean it will happen though, and I don't want it to, is that guidance from management is lowered or stays exactly the same. And I'd lean towards staying the same because Palantir has been one to kind of revise guidance upward, but not in big ways. Like if we compare full year 2023 guidance from Q1 and Q2, you see that the kind of raised guidance, but also kind of didn't. In Q1, full year 2023, revenue was supposed to come in between $2.185 billion to $2.235 billion. Now, if we go to Q2, the guidance for full year 2023 revenue is now in excess of $2.212 billion. So it was still lower than the high end of the previous quarter's guidance, but they raised the floor from 2.185 to 2.212. So it's still positive, but in my mind, that's basically keeping guidance the same and being more confident that you'll hit the middle range. Now, if you do the same thing with raising the floor, that's not so bad. But if they keep it exactly the same here, because it is a conservative way to say that we are still betting in excess of $2.212 billion, you can technically spin it as not decreasing and maybe saying you're just more confident in being higher than that. But I think expectations are we want management to show the confidence in their growth going forward, hence a revision upwards, because they're talking up AIP demand, AIP bootcamp success. So without customer counts, the next best thing might just be to raise guidance because we'd assume the marketing is driving their confidence. Now, these are all speculations here, but do you have other red flags you're keeping a close eye on? Just let me know down below.